Welcome to C4S classes. Today we are continuing our objective series session where we'll discuss objective questions that are relevant for RBI examination. So today's discussion will be on Forex market. So currently India holds Forex reserves equivalent of $643 billion. So we'll be discussing terms and concepts that are related to Forex market. So our first term for today would be bid ask spread. So here bid means buying price and ask means selling price. So bid ask spread is the difference between buying price and selling price of a currency pair. Now for some context, if you want to understand this term, let's say bid rate is 84 rupees 19 paisa for $1. All right. And selling price, that would be ask rate, is 84.22 rupees for $1. Now let's say these are the prices of rupees in the forex market. So bid ask spread would be 0.03. We will The difference between the two prices will be the bid ask spread. So bid ask spread tells us about the market liquidity of a currency. So if a currency is more liquid or more easily available, the bid ask spread would be less. That means the difference between the buying price and the selling price of a currency would be less. Now, let's see another term. Another term is PIP. P-I-P. So this PIP means percentage in points. So it is a unit of change in a exchange rate of currency pairs, right? Unit of change. In forex market, changes in currency pair rates is defined by PIP. All right. So our next term is swap. You might have heard this term in news articles many times. Let's see what is swap. So in swap, simultaneous purchase and sale of different currencies for delivery at different dates take place. So it is mainly used for hedging and managing currency risks. What happens is when there is interest rate differentials between two currencies, so arbitrage opportunities are created, right? And these arbitrage opportunities are cashed using swaps. All right. So next term is cross rate. So cross rate is the exchange rate between two currencies. It is the exchange rate between two currencies, any two currencies. But here condition is those two currencies should be any currency other than US dollar. All right. So now that we have discussed these terms, let's discuss the objective questions for today's session. Okay. So here a paragraph is given where foreign exchange reserves of India are discussed. So based on that topic, some questions are given. So first question is bid ask spread that we have discussed earlier. So the answer would become D. Difference between the buying price bid and selling price of a currency pair. Next term is PIP commonly used to describe in the forex market. So the answer would be smallest price movement in a currency pair. It is a unit of currency change. So it would answer would become smallest price move in a currency pair. Third question is here what they have given is the definition of a swap, right? So if you know the definition, you can easily mark the answer as swap. Next, they have asked what is cross rate. So here exchange rate between two currencies, neither of which is US dollar. This is important, right? Neither of which should be US dollar. Then only it would be called cross rate. Now, question 5. This question pertains to a 5th January circular regarding exchange traded currency derivatives, right? So here its implementation has been extended by RBI from April 5th to May 3rd. This date needs to be remembered. Other than that, let's move to next question. Now let's see. This question looks complicated, but it is very simple, right? So the question is, which currency pair is most likely to experience volatility during geopolitical tensions involving the US? Right? Since we know the country which is involved in the crisis, we should just check the option which contains its currency. That would be the answer. So in all these 5 options, only one option has US dollar as currency. So it would become the correct answer. Right? Next we move to question 7, which is how can geopolitical tensions affect cross-border capital flows? So for question 7, let's see geopolitical tensions impact on forex market is asked, right? So as such tensions rise, what happens is investors look for opportunities where economies are stable so that their gain is assured. Now, when cross-border geopolitical tension persists, such economies would be having fluctuations or volatility in their markets. So the answer would become decreased capital inflows due to higher risk perceptions. So investor would run away from such markets rather than investing in such markets. All right. So that's all for today. Thank you for listening. Have a nice day.